The White House is floating something that could change everything you thought you knew about gold, silver, and the future of your savings. And they're doing it while crypto crashes and the headlines scream chaos, price floors for critical minerals. That's the phrase being whispered in rooms where trillion-dollar decisions get made. And if you think that's just about lithium or rare earth metals, you're missing the bigger picture. Because when governments start admitting that market volatility is a national security threat, when they start talking about putting guardrails around strategic commodities, you have to ask yourself one simple question. What comes next? And more importantly, what does this mean for the metals sitting in your safe or the cash sitting in your bank account? If you're someone who values straight talk without the hype, go ahead and subscribe right now. This channel exists to cut through the noise and give you information you can actually use. No clones, no copycats, just real analysis for real people. It's early February 2026, and a senior official just gave a speech that most people ignored. But you shouldn't have. The core message was blunt. Global markets for critical minerals are broken. Supply chains are fragile. Prices swing wildly because of forces that don't care about American jobs, American mines, or American security. And then came the line that should make anyone who owns hard assets sit up straight. We need to make prices more predictable, so investment can finally show up. Sounds reasonable, right? Stability, predictability, who wouldn't want that? But the moment you hear the words price floor, you need to start asking harder questions. A floor for what? Paid by whom? Enforced how? And for how long? Because here's the thing. Governments rarely announce price controls with a big flashing sign. They do it through contracts, incentives, tariffs, and stockpiles. Things that sound boring enough to slide past the evening news. It might look like multi-year purchase agreements where a government-backed buyer promises to take a minimum volume at a minimum price. It might look like tariffs that punish cheap imports flooding the market. It might look like a strategic reserve that steps in when prices collapse, not to make anyone rich, but to keep a supply chain from dying. And the first announcement is never the full policy. The policy is what happens after the market tests you. Because if you say you'll defend a certain price level, the fastest way for traders to make money is to push that level hard and see if you blink. So if this turns real, expect stress tests, expect volatility, and expect the actual outcome to be decided in the boring parts. How much funding gets allocated, what materials count as eligible, whether allies actually coordinate or just talk about it. That's why this matters. There's a version of this that makes sense. Strategic stockpiles, long-term contracts, government acting as a buyer of last resort when dumping kills a domestic project. And there's another version that becomes a clumsy, expensive political machine that backfires the second the market smells weakness. And here's what most people are missing. This isn't just about lithium or nickel. If Washington sets a precedent that it will coordinate price floors for strategic commodities, what do you think the gold and silver crowd hears? They hear the government admitting that volatility itself is a risk. They hear someone wants to put limits on the inputs that power modern life. And then they ask the obvious question. If you can do it for critical materials, what stops you from trying to do it for monetary metals? Now, before we go deeper, let's talk about what's actually happening with prices right now. Because over the last few sessions, silver has been whipping around like it's designed to shake people out. One moment it's ripping higher, then suddenly there's an air pocket and it drops. Gold does the same thing, just with a little more composure. Based on recent numbers, spot gold has been hovering in the high 4,000s per ounce after printing fresh records late last month. Silver has been fighting in the high 70s to low 80s range with violent intraday moves that can make your stomach turn. If you've ever noticed that metals seem to rally in the quiet hours and sell off during the day, you're not imagining things. I'm not accusing anyone of manipulation. I'm just saying thin liquidity creates opportunities for strange price action. And if you believe in coincidences, that's your choice. But here's what makes this whole situation feel off. Paper prices and physical prices are telling different stories. On the futures screen in the US, you see one number. On the ground, where people actually take delivery, you see another number. And right now, that gap is significant. In Shanghai, silver has been trading meaningfully above US futures with a double-digit percentage premium that keeps holding even when paper sells off. Think about what that means. If silver were truly abundant and easy to get, buyers in one of the world's biggest industrial regions would not be paying a fat markup to secure it. So when someone says the price dropped and the problem is solved, I have to laugh. Because a lower screen price doesn't magically refill vaults. It doesn't increase mine supply overnight. And it doesn't reduce demand from electronics, solar panels, data centers, and everything else that treats silver like essential wiring for the future. Let's talk about something that costs regular people money. The spread. If you've never bought physical metal, you look at spot price and think that's what you'll pay. Then you try to buy and get hit with a premium. Then you try to sell and get hit again, except this time it's a discount. A thanks for playing fee. Right now, those spreads are ugly. Some dealers are quoting buy premiums in the low double digits. Some are paying well under spot to take metal back because they're terrified the next 24 hours brings another violent move and they will be stuck holding inventory that reprices lower before they can hedge it. So let's be honest. If you're buying physical metals expecting to flip them tomorrow, you're playing the wrong game. Metals aren't day trade toys. They're long-term insurance. And insurance always costs something up front. Here's another trap people miss until it's too late. On days when metals are moving fast, the spread isn't just dealer greed. The spread becomes a risk management tool. If a shop buys from you at full spot and the market drops hard before they can hedge, they can get wiped out. So they widen the bid, they widen the ask, they try to survive. That's why when you see insane premiums, it doesn't automatically mean shortage tomorrow. Sometimes it means inventory is thin and nobody wants to be the one caught standing still. Don't just look at the premium number. Look at how long it lasts. Look at whether it tightens when volatility calms. That's where the real signal lives. Now back to that speech. The official described a pattern everyone in commodity markets recognizes. A domestic mining project gets announced, financing starts lining up. The plan looks viable, and then almost like magic, new foreign supply appears. The price collapses, investors disappear, and the project dies. You've seen this movie before. That's dumping, that's predatory pricing dressed up as free market dynamics. And in critical minerals, it's not just economics, it's geopolitics. So when you hear price floor, you need to translate what that really means. It could mean we'll guarantee demand and a minimum price so you can finance the mine. Or it could mean we're going to distort the market and hope it doesn't explode. Here's my skeptical take. Price floors only work if you have three things: a credible buyer, a credible enforcement mechanism, and a credible willingness to keep buying even when it feels painful. Without those, the floor becomes a press release. And markets eat press releases for breakfast. But the fact this is being discussed at high levels tells you something important. Policymakers are finally admitting the invisible hand has been getting twisted. Recent mineral summits included discussion of coordinated pricing floors among allies, explicitly framed as reducing dependence on a single dominant supplier. That's not a small statement. That's an acknowledgement that the old system wasn't delivering resilience. And now here's the twist. The same people asking for predictable pricing in minerals are also watching the monetary system wobble. Which brings us to the other headline. Crypto melting down while metals refuse to die. Bitcoin has been sliding hard this week, briefly touching levels around 70,000 after a broader tech-led risk-off move. If you're in crypto, you'll call it volatility. If you're in metals, you'll say, welcome to Tuesday. And if you're a normal person, you're wondering why everything you own seems connected by the same invisible cable. Because it is. When big portfolios de-risk, they sell what they can sell, not what they should sell. Liquidity becomes the weapon. Correlations go to 1. That's why on rough days you'll see stocks down, crypto down, and metals down together until the dust settles and the true safe havens reassert themselves. In the middle of all this, a famous business personality made a viral comment. Nobody's buying gold. Try to sell a big amount and watch what happens. You'll get offered way under spot. Meanwhile, crypto is instant. Let's slow down. There's a kernel of truth and a mountain of nonsense in that statement. Kernel of truth. If you walk into a random shop with a pile of metal demanding instant liquidity at full spot, you'll be disappointed. The dealer has to verify authenticity, manage price risk, and they're not running a charity. Mountain of nonsense. The idea that this means metals aren't real and crypto is more real. Reality is boring. Different assets have different settlement rails, different fraud risks, different liquidity profiles, and different roles in a portfolio. Gold isn't meant to be a 5-minute flip. And if your argument is, I can move crypto fast, congratulations. You discovered the feature that also lets it crash fast. Here's a question. If instant settlement defines what's real, why isn't a wire transfer the greatest asset on earth? Exactly. When you talk about selling $10 million of anything, the market isn't the same as the guy buying one coin. Institutional gold trades with spreads that are nothing like retail coin spreads. It can be moved in large bars through secure chains of custody with tight pricing when you're in the right channels. So using retail spreads to claim nobody's buying is like judging the entire housing market by the price you got for your used couch. Now let's talk price targets, because this is where people start making life-changing decisions. Several major financial institutions have been floating extremely aggressive gold forecasts lately, numbers that would have sounded insane just a couple years ago. Recently published projections have put end of next year gold targets in the low 6,000s per ounce. Whether you believe those targets or not, the more important question is why those forecasts exist. Central bank demand, reserve diversification, and a persistent distrust in paper promises. Central bank buying stayed historically elevated through 2025 with hundreds of tons added globally. One more point on gold, because people underestimate how psychological this has become. The last couple of years trained everyone to think of gold as the old man asset. Then the price started behaving like a momentum trade. And now even mainstream retail has been creeping back in through funds and simple brokerage products. That's part of why the swings are getting sharper. That's not automatically bullish. Retail can be hot money. Retail can be trend chasing. Retail can panic, sell at exactly the wrong moment. But it does change the character of the market. It means the next pullback can look like the end of the world right before it turns into the next launch pad. If you want a simple way to check silver versus gold without becoming a spreadsheet expert, watch the ratio. When gold is expensive relative to silver, silver bulls call it a catch-up trade. When silver is expensive relative to gold, gold bulls call it quality over chaos. Either way, the ratio tells you where the crowd is leaning, and crowds are often wrong at turning points. Price targets make great headlines, but positioning makes real outcomes. That's not retail panic buying. That's institutions with infinite time horizons saying, we want less exposure to someone else's promise. Does that guarantee straight line upside? No. In fact, here's something that might annoy gold enthusiasts. The higher the price goes, the more violent the pullbacks tend to be, because profit taking gets bigger and leverage gets shaken out. But structurally, the bid under gold has been real. Silver is different, and that's why silver is both thrilling and terrifying. Silver has industrial demand. Silver has a smaller market. Silver gets squeezed harder, and silver also gets punished harder when liquidity dries up. If you're going to play silver, you need to accept it can feel like a roller coaster designed by someone who hates you. If you found this breakdown helpful, hit that like button and drop a comment. Let me know what you're thinking. Are we heading toward more government control over commodity prices, or is this just noise? Another data point that got attention. Reports of physical tightness and premiums, not just in China, but in other hubs too. When you see multiple regions paying double-digit premiums for physical, that's not a nobody wants it story. That's a paper is discounting something that physical is pricing in story. And that's where interpretation matters, because there are two explanations. One, physical is truly scarce. Two, logistics, taxes, and friction are creating regional premiums that don't necessarily mean global scarcity. Shanghai's premium calculations can be distorted by tax treatment and import constraints. So you can't just look at one number and scream shortage. There was also talk about a massive bearish bet against silver, some big player leaning short right before a drop. Maybe that's true. Maybe it's exaggerated. But even if it's true, here's the thing. Big shorts don't prove silver is doomed. Big shorts prove silver is important, because nobody builds a $500 million position against something they think is irrelevant. They do it because the payoff is huge, or because they're hedging exposure you can't see. Now, let's talk Bitcoin for a minute, because this ties together. Bitcoin fell sharply this week alongside a broader sell-off in global tech and risk assets, as investors got nervous and moved toward traditional havens. There's a rumor that made the rounds about a major emergency meeting overseas and a giant liquidation of assets to defend a currency. Maybe it's true. Maybe it's social media fiction. Either way, even the rumor tells you something. Currency stress is back on the menu. And you don't have to believe the wildest version to take the underlying signal seriously. We know from recent numbers that currency and rate expectations are shifting. The dollar has been firming during bouts of risk aversion. We also know commercial real estate isn't exactly healthy. Office-backed commercial mortgage-backed securities delinquency has climbed into the low 12% range, setting record highs in recent tracking. That matters because delinquency is like mold. If you see it in one corner, it's usually in the walls too. Then people say, we're not in a recession. Maybe not officially. But leverage doesn't care about your official label. If enough weak structures exist at once, any shock can cascade through the system fast. That's why Bitcoin's move isn't happening in a vacuum. When you see big red candles, people immediately invent stories. Some whale sold, some institution dumped, some exchange did something shady. Sometimes those stories are true. Often they're just coping mechanisms. The simpler explanation is usually right. Thin liquidity, forced selling, and the reflexive nature of leveraged markets. Crypto is a leveraged market even when you're not using leverage because the marginal buyer often is. Right after a flush like that, the pump crowd shows up. They tell you Bitcoin's going to 1.5 million, 10 million, 100 million. Whatever number gets attention. And they say it with the confidence of someone selling miracle cures out of a trunk. My question is always the same. What's the mechanism? Don't just give me a destination. Give me the bridge. Because if you can't articulate the bridge, you're not explaining, you're marketing. To be fair, there's a real argument for why volatility rewards disciplined people. If you have more time than money and you're willing to study, volatility is opportunity. But it's also a guillotine for the lazy and overconfident. If you've had success navigating these markets, share your story in the comments. Others can learn from real experience. Now here's something most finance channels won't touch because it's not flashy. Accountability. This matters because the same theme shows up everywhere. Who pays, who benefits, and who gets away with it. There's been discussion around county-level tax assessment systems that allegedly got rigged through incompetence, conflicts of interest, and refusal to do real forensic audits. The pattern is familiar. Someone acts like they want the truth, pushes for an investigation, then steers things toward a feel-good review instead of a real teardown, a fluff piece instead of a microscope. If you've ever watched a corporation investigate itself, you already understand the punchline. Real fraud isn't solved by vibes, it's solved by evidence. Proper forensic work could document mechanics in days if you know where to look and what data matters. And when that doesn't happen, trust erodes. You might be thinking, what does this have to do with gold and silver? Everything. Because the macro story is built on the micro story. When people lose trust locally in tax systems, bond systems, governance, they start looking for assets outside the system. That's how you get gold resurgence. Not just because inflation exists. Inflation always exists. Gold rips when credibility collapses. The root cause isn't complicated. No accountability. Officials approve massive debt. Consultants write reports to justify it. The same people who benefit from spending your money also get paid to tell you it's fine. Then years later, the bill arrives, and households get crushed not just by principal, but by compounding interest stacked on top. We already mentioned office commercial mortgage-backed securities, delinquency hitting record highs. That's one visible crack in the debt wall. And the stress isn't isolated to one building or one city. It's broad enough that lenders and insurers are repricing risk across entire categories. That's not ideology, that's math. This connects to power grids and data centers. We're going to need huge upgrades. And the instinct will be to issue more bonds, even though the system is already strained. The most uncomfortable question. If the money doesn't exist today, how does it magically exist tomorrow? That's fair. But here's the counterpoint. The money can exist in the sense that governments can raise taxes, cut spending, or inflate away obligations. Those are all ways of forcing the money to exist. The question isn't whether they can extract resources. The question is what kind of society you get after they do it. Once a system starts managing outcomes, it rarely stops at the first outcome, and that loops us right back to the start. Price floors, commodity stability, strategic stockpiles. These aren't isolated policies. They're signals about how leaders view the world. As something to be managed, not something to be trusted. And that's why gold and silver keep showing up in the conversation even when crypto is the shiny toy. If you've tried to buy or sell physical silver in the last 30 days, drop a comment and let me know what premium or discount you actually saw. Your real-world experience matters more than anyone's hot take. We started with the idea that governments may coordinate price floors for minerals to keep supply chains alive. We watched metals whip around with physical premiums, refusing to die even when paper gets punched. We watched crypto fall with risk assets and learned again that instant doesn't mean safe. And we ended with a reminder that the trust problem isn't just macro, it's local. If there's one practical takeaway, it's this. Don't confuse price with value. Don't confuse speed with safety. Don't confuse a headline with a mechanism. Don't put yourself in a position where one bad day forces you to sell the thing you wanted to hold. This story isn't done. It's about to get weirder. Make sure you're subscribed so you don't miss what comes next. And if this video helped you see things more clearly, share it with someone who needs to hear it. None of this is financial advice, just breaking down public information and market behavior in plain terms so you can think for yourself before you make any moves.